Hello viewers, welcome to Season 2, Episode 4, Your Money, Your Taxes. I'm Lalit Abichandani and owner of Abic CPA Associates, and our episode today is about real estate investment planning, my favorite topic, and Paresh Ji, who is expert in this area, will be educating us about this topic. Paresh Ji is the CEO of Paresh Shah Financial Services. He's certified financial planner and a wealth strategist for the past 17 years, and he's been helping individuals, businesses co-create innovative financial strategies. He's a licensed CPA presenter, and he educates CPAs as they guide their clients on investments, life, disability, long-term care insurance, not to mention real estate. He also specializes in pension profit sharing plans, asset protection, estate planning, and business succession planning. Paresh Ji graduated as chemical engineer from prestigious IIT Kharagpur. He is the 2016 honoree of Long Island Business News Leaders in Diversity Awards. Paresh Ji resides in town of Hicksville, Long Island, New York with his wife Shemol. Their son Shamik is a sophomore at Stony Brook University in Long Island, New York. Paresh Ji, welcome.
Thank you, Lalit ji. Thank you for the great introduction. Really appreciate it.
So Paresh Ji, today we are going to talk about my favorite topic, real estate investment planning. So last time we were talking about this purchase of single family homes. This week let's talk about investing in real estate. Direct purchase of real estate may or may not be possible for some investors for lack of big funds. But do they have real alternatives? The average working people, do they have real alternatives to invest in real estate in a meaningful way?
Lalit ji, this was how the stock market was essentially created in the first place. That means people had ideas to create businesses, but they did not have the capital individually as single families to invest in these ideas and to convert them into businesses. At times, even small groups getting together could not raise enough capital amongst themselves to be able to implement these ideas. So they got together and they approached the public, and they raised money by exchanging ownership in the form of shares. That's how we had shares created and the stock market was created as a place where liquidity for these shares could be obtained. So in the same way, for the real estate market, a new instrument was created, and it was called the REIT, R-E-I-T, Real Estate Investment Trust. These were the instruments by which the small investor could invest in larger real estate projects.
So Paresh Ji, for an average investor, could you please tell us what do these REITs do? I know they have real estate in there,
Yep.
but what do they really do? If you can give us more details.
Right. Lalit ji, the REITs have existed for more than 50 years now. In fact, in 1960, under the Cigar Excise Tax Act, the government introduced the legalization or legal permit to have REITs. And in 1965, Continental Mortgage became the first REIT to be listed on the New York Stock Exchange. In fact, it was later that Europe came out with their own version, and Netherlands was the first to issue this in 1969. I mean, first to legalize this, first to pass the law to permit REITs in 1969. Now, REITs can be used for any number of things. Like, people can first of all say there might be a project in which land is purchased, construction is done, and then property is sold. It could be homes, it could be single family homes, it could be multi-family homes, it could be condos, any such type of project in which there is construction, first obtaining of land and taking it to construction and sale, where there is large amount of capital needed, can be done through a REIT. That is one example of a REIT. Or there could be projects in which there is in property which is already constructed, and that property can be leased out or rented out. Sometimes it's already leased or rented out. So the REIT goes in and obtains or purchases such property for those group of investors who want steady rental income out of these properties. So any such project in which there's a large block of capital needed for the real estate can be invested through a REIT, or a REIT can be created for that type of investment, and then the lay investor can invest in it once it is listed.
So you are really investing in small units, but
Yes.
but it's still a real estate investment.
That's correct.
But what are the risks for an average person in something like this?
Risks, Lalitji, are pretty similar to doing a real estate project on your own. I mean, let me give you one example. Let's say, for example, if a project that's being taken up is the development of land into a series of condo apartments to be sold. Now, there could be, after the land has been purchased, there could be some zoning issues that might create challenges. Or when the construction is being done and the ground is being dug for the purpose of the foundation, at that time there could be a challenge with when you dig in, you might find that the soil is not what was expected and the foundation may not be proper. There could be problem with delay in permits. Any or all of these issues can cause delays in the project, and because the money has already been invested and money is, so to say, quote unquote stuck, there is illiquidity. So these are some of the challenges that could be with a development project that is being done through a REIT. Let me take the other example that I took, which is of a project in which you don't want to take such high risk. So what you do is you kind of buy into already existing property that's been rented out. But in that case, if the demographics of the area change, then maybe you might end up with some vacancies, or you might end up with having the rent levels falling in that area. Any or all of these challenges can cause the value of the REITs to go down. So in this way, you really need to be, I mean, these are some of the risks, and it's not like just because you're investing through a REIT, that means you're guaranteed to get success in your project.
So Paresh, but real estate investments, we know, have a lot of tax advantages, especially people who invest in one or two families. They understand the property is under their name and they take the tax advantages. And we have spoken about this in our earlier episodes as well. Are these retained in REITs as well? So are they getting the similar tax advantages?
Yes, Lalitji. I mean, most of these REITs tend to be structured either as limited liability partnerships or LLCs. And in these LLC structures, there are first advantage, of course, is that, let's say if it's a limited liability partnership, then there can be general partners and there can be limited partners. So the persons who are managing, or the promoters of the project, can be general partners, and in turn they can retain the risk involved, and they can keep less risk on the limited partners. So the people who are investing in these projects, actually their risk is mitigated. So that is one advantage that is passed on. But then, because it's an LLC or an LLP structure, therefore all the benefits like the costs associated with the project, the depreciation, and all the such advantages that a normal real estate project will have, all those can be passed on to the investor. In fact, I'd like to add some more advantages that are there inside these projects. So the reason why small investors tend to gravitate towards mutual funds is because here you have professional management, and you have someone who's looking at projects on a day-to-day basis and looking at that project and trying to ensure its completion so that the investor can get adequate returns. In the same way, you can get the advantage of professional management, and you don't have the day-to-day responsibility inside the REIT. So on one hand, you have all the tax advantages, But on the other hand, you also have professional management, which actually in a way can mitigate the risks that I told you about earlier, Laliji. The risk that the project might get delayed, or that there could be other challenges with the area. The professionals who are looking at it every day may help protect the investor in the right way across the life of the project.
Paresh, these advantages sound great. What about downside? Are there any disadvantages of owning REITs? Can you explain to us?
Laliji, again, each case may be different, and I do not want to kind of specify what could happen. But end of the day, professional management, Lalitji, can be expensive. We can have the costs of the project can go up. The fees that are being charged by the managers may tend to eat into all the profitability that is there for the investor. Sometimes we also see certain terms and conditions in which certain amount of profit is first given to the persons who are managing the project, and then it is distributed to the remaining partners. So in that case, there is a risk that there might not be enough profit to come down to the investors. That's one thing. Second is that, again, pretty much the general partners in a limited liability partnership will have almost entire control on the project as well as on the cash flow. So you really need promoters who've been doing this for a while and who are trustworthy, and you can invest in them. It's all like investing in any business or in any company, but in this case the risk can be a little more. So we need to the investor needs to really be careful about where he's going with this investment.
So Paresh, what you're describing is basically the listed or a public limited REITs. So like any other public limited company, they have similar disadvantages. The top management might eat away some portion of that because they have the rights and the cash flow under their control. But can you tell us about the alternatives? Are there any private placement REITs as well?
Right. First of all, Lalitji, let me put in a disclaimer. As a registered representative with FINRA, we cannot recommend any private placement real estate investment trust. We only recommend those real estate investment trusts, REITs, that are listed. Having said that, let me tell you a little about what's going on in the world of private placement REITs. So there are certain projects which are considered to be very high risk, and in only those investors who can absorb the illiquidity, that means they can block their capital in those projects and they don't need that capital, as well as those investors who can probably take the loss, in those projects, those particular investors can invest in those. We call them accredited investors. So there are a lot of these new websites which have come up with group funding of these kind of projects, and investors really need to be careful because some of these are open only to accredited investors or can be high risk, and they should be careful while investing in these type of projects.
So very quickly, Pareshji, we're running out of time, but very quickly, you would recommend them to be in anybody's client portfolios, these kind of either listed REITs or private placement REITs?
Don't want to say too much about private placement REITs, but definitely when we are considering stocks, bonds and alternate investments, then REITs would form a part of the alternate investments of anyone's portfolio, and we do consider them all the time.
Yeah, we know that the real estate is a bigger segment of our economy, and obviously if you're only investing in stocks or bonds, even my recommendation is to go some percentage in real estate investments. Thank you very much, Pareshji, for great insight into this area, which is the people have very little information about that. Yeah. So we need to educate more about this REITs and real estate investments to our viewers. In next few shows, I think we should take up this topic again and give a little more detail so that viewers can get more information. Thanks again for coming in and giving us information about real estate investment planning.
Thank you.
Thank you, and see you in 2 weeks, viewers.